Warm welcome to another week ahead video, guys. Now this week we have another fairly light schedule coming up, so our attention will turn to overall risk sentiment, especially after last week's jittery price action across risk assets, as well as that incoming US CPI. Now, can US CPI finally liven things up for us from a volatility point of view? I mean, we do sure hope so, because over the last few weeks, we've seen some pretty typical summertime trading conditions. We've had thinner liquidity, lower volumes, and to make matters worse, we also have the market in a little bit of a limbo state right now until they have more clarity on whether the Fed will taper slowly or taper fast. Now, if we take a look at some of the key markets out there, just going back to a month ago, we can see that the S&P, WTI, US 10-year yields, dollar index, all of them pretty much exactly where we were just a month ago, all of course apart from the VIX, which has seen a little bit of a move to the upside. Now, the past week, we did see a little bit more of an interesting risk-off vibe coming out, especially on Friday. And of course, as usual, commentators provided a plethora of reasons for that move. Some blaming virus cases, others blaming growth concerns, others blaming Fed tapering and a possible Fed policy error, stagflation, sticky inflation, seasonality, just to name a few. But as is often the case, there might be a far less sinister or rather flamboyant reason for the potential jittery price action that we've seen. Now, some analysts have recently noted a very interesting phenomenon happening around OPEX with equity prices. As you know, stock and index options usually expire on the third Friday of every month. And from the month of May, we've seen equities take a tumble lower on every one of these occasions. Now, some of these moves has been more severe and less severe, but the most important aspect to take away from it is that all of these moves lower basically occurred around OPEX, and with every single move lower from May, we've seen dip buyers stepping back in, especially really defending that 50 DMA to the downside. Now, we've spoken about this quite a few times in the terminal, and it's very much old news right now for markets. So there is a possibility that the jittery price action on Friday could have been a few players potentially trying to front run that expected move to the downside. Also keep in mind that this upcoming Friday's OPEX will garner a lot more attention than usual, because it's of course also quad witching this Friday, which means increased volatility was already higher, or higher probability at least, even without this very interesting phenomenon that we've seen playing out. So in terms of the week ahead, then our main focus will be on two things. Firstly, risk sentiment, like we said, and then that upcoming US CPI print. This CPI print will of course be the only big ticket item we've got left for the US from a data point of view going into next week's FOMC. And after the NFP report we had, the disappointing one, the odds of an official tapering announcement at that September meeting has fallen considerably. And this week's CPI print, because everybody is focused on jobs right now, it might not be enough to sway markets for this upcoming September meeting, but there is a few things that's interesting to consider. I mean, when it comes to inflation, what the FOMC hawks have to say right now doesn't really matter, because we already know what they think about recent price pressures, and similar there for the doves as well. What's really interesting for us is waiting to see how the neutral FOMC members, what they have to say. And that's for us, far more important right now, because their votes could sway the median out. Now, we've had some very, very interesting comments coming out recently from Fed members, the likes of Mester, the likes of Esther George, very interesting comments, Bowman, Clarida, Qualls, Daly, Barkin, some very, very interesting comments coming out around inflation. Some of them being a little bit more concerned about rising inflation pressures. Some of them, still sticking to that transitory view. Now, of these 7 neutral FOMC members, the 2 non-voters, which is of course Mester and George, 2021 non-voters, they've been the most outspoken and arguably leaning more to the hawkish side when it comes to tapering and inflation. And the remaining 5, 3 of them are permanent, and the other 2 are only 2021 vote. And all 5 of them, they've been more reserved on tapering and inflation comments. So if we do see a materially weaker CPI print coming out, that might be enough to keep those 5 members more reserved. But the risk is also there that if we see a much stronger than expected print, that could encourage them to take a second look at inflation, and could see them tilt more hawkish going into next week's meeting. Now, the other thing to consider as a side note, and something we've mentioned recently in the terminal as well, is the difference between the 2021 and 2022 voting structure for the Fed. Because we have Fed's Mester, which currently is neutral, but like we said, leaning more towards the hawkish side. We've got Bullard coming in, Rosengren, as well as George. All three of them very, very hawkish in their policy stance right now. So this is where incoming CPI and jobs data becomes a lot more interesting, because it's not really just about the here and the now, i.e. the starting date for when incoming tapering will take place. But right now, the incoming data is very important because it could potentially change the mind of those neutral members about the pace of tapering. That's much more important right now. You know, whether we start tapering in October or November or December or January, it won't really make much difference for the markets. But what will make a difference is whether tapering is concluded by the end or by the middle of next year. So that is really where a lot of this focus comes in from the or for the CPI print. Now, on the inflation front, the market consensus expects both headline month-over-month and year-over-year CPI to print with a slow or slight drop from the prior month. A similar story there for the core CPI year-over-year, with the core month-over-month print expected to remain unchanged. Now, there's quite a few interesting things to consider for incoming CPI prints. Firstly, a key reason for expecting the current price pressures to be mostly transitory was the assumption from markets that the supply chain disruptions wouldn't hang around forever. And even though this argument still holds true, the current virus situation around the globe has thrown a bit of a spanner in the works on that front, because as long as the globe goes through wave after wave of the virus and lockdown after lockdown, these supply chain disruption pressures can hang around a little bit longer, meaning inflation is potentially a little bit more sticky than previously thought. Secondly, it's the possibility that the labor market slack isn't absorbed as quick as some had expected or hoped for it to be. We've seen a huge surge in the available jobs in the market. So the demand for jobs is there, but right now the market is struggling to find the supply, the actual workforce to fill those positions. Now, if we see companies being more and more forced to continue raising salaries and wages just to try and attract the right candidates for their available positions, that could of course eventually kickstart something like a wage price spiral, which, if combined with continued supply chain issues, could really see companies forced to pass through a whole lot of additional cost to their customers, and of course that means hitting consumers' pockets. So definitely something to consider. The other factor to watch, though, is shelter. A recent research paper from the Dallas Fed suggests that the biggest component, which is close to 40% of US core CPI and PCE, is rent and owner's equivalent rent, and that might be locked and loaded for a possible surge to the upside. Now, according to this research paper from the Dallas Fed, both components, whether that is rent or owner's equivalent rent, could see increases of about 7% or close to 7% by the end of 2023. Now, with the current eviction moratorium still in place, that has basically just exacerbated the lag as well as the follow through for some of these price pressures. But once that is lifted, some analysts are expecting a huge surge in CPI as a result, and that could see trouble for the transitory narrative that's in the markets right now. But, when looking at shelter, we also need to consider and take into account that it's not only rent and owner's equivalent rent that we need to take into consideration for shelter component. We also need to take things like lodging away from home into consideration, and that is expected to normalize after the massive rises we've seen to the upside. So that should offset some of that expected rise going into 2022. But the point is that whether we take a look at supply chain disruptions, whether we take a look at the labor market, or take a look at the rent and owner's equivalent rent components, there's a couple of things that could spark some inflationary fears coming back into the markets, and that's definitely something we'll be paying attention to in this upcoming week. So in terms of a possible trade plan for the week ahead, it's really going to be very simple, guys. Like we said, we're focusing on either risk sentiment or that CPI print. In terms of potential hawkish outcomes for the dollar, if we see strong risk of sentiment that follow through from Friday playing out, just like we've seen every OPEX playing out, that could lead to some downside, of course, for US yields, downside for S&P 500. More mixed flows expected for gold, because downside in yield should be good for gold, but upside in the dollar should be bad for gold. So taking more of a neutral bias on gold on that front, and then upside for the dollar. If we see CPI printing close to or above maximum expectations, we would expect that to see upside yields, downside S&P, downside gold, upside the dollar, and then of course just the exact opposite when we look at a strong recovery in risk sentiment or US CPI missing close to or below minimum expectations. All right, guys, so that's everything from our side for the week ahead. As always, if there's any questions, don't hesitate to let us know. Good luck in the week out there.